Although I previously talked about productivity and productivity growth, you can watch that video if you follow this link right here. Today, I want to take a deeper dive into understanding what productivity growth is all about. As you recall from that previous video, productivity is that relationship between inputs and outputs. So we can think about, labor and capital and raw materials, electricity, those types of inputs, and we can think about what that creates, the outputs, the products and services. Obviously, we want this ratio to, favor fewer inputs and more outputs. And as that dynamic changes, that is the productivity growth we're talking about. So what drives productivity growth? Well, there are three major things. One, there is labor productivity. That's the amount of output you get per hour worked. That's labor productivity. There is multifactor productivity. So this is, if you think about the changes in outputs that you cannot account for in terms of changes in inputs, that's multifactor productivity. And there is also capital deepening. And this is really all about that capital to labor ratio, right? So as that would go up if you increase capital, would also go up if you decrease labor, but that is what capital deepening is about. So if we go and look at some data using these three things, we can see that this productivity growth ebbs and flows. So we can see in this, 1984 to 73, we had pretty good growth, as we did in the period from 95 to 2004. We had pretty good growth, but then we had these periods in between where things are not good. 2004 to 2015 is actually through now. I mean, it's really still been pretty stagnant there. We see productivity growth is pretty bad here in the US over the last almost 20 years now. And you can look at this if you want to stop it and see, the breakdown between those three types of inputs. Now, this is true pretty much throughout the developed world. So it's not as bad as some of the emerging markets, but we see this trend where productivity has been going down for the last, 20 plus years. We also can see that it's true kind of across industries. If we look at that 2004 to 2014 period here, we see that mining, information, and that financial, insurance, real estate, those are really the only three industries where we saw some productivity growth in this period. Everything else was down from prior periods. We can also see that kind of that gap between the growth in the information sectors and the other sectors, that seems to be slowly widening here, which shows that productivity growth, growth is kind of isolated in certain parts of the economy. I will follow this up with another video where we talk about what are the possible explanations for this, right? We think about a number of things that should be helping us increase productivity, but that's not happening. So we'll talk about that in a future video. I'm Brian Kozlowski. Thank you so much. I hope you enjoyed that.